So let's start the new chapter, that is deductions from gross total income. So this chapter is popularly called as chapter 6A deductions. Under income tax, I have repeatedly saying this point, the Income Tax Act is broadly classified into 23 chapters. Inside that, chapter 6A, it deals with what are the deductions that a person will get from the gross total income. Now, first of all, what is a gross total income? What is gross total income first? Gross total income means sum of total of all heads of income. Like all heads of incomes, how to compute income, we know under each head. Income from house property, we know annual value minus deductions. Then you get income from house property. So compute for all houses income from house property, total it. Then compute income from PGBP. Then compute capital gains. Then compute other sources. Then salaries, total it. And apply clubbing provision, set off and carry forward everything. Then once set off and carry forward everything is applied, getting it, still some positive amount is there, and that's called gross total income. Able to understand? But generally, when we are computing gross total income, we have some incomes which are taxable at special rates. There are some incomes which are taxable at special rates of incomes. Getting the point? Now, in these, there are many incomes like 112A, 112, 111A, 115BB, getting it, 115 BBE. So like this, we have some special incomes. These incomes are black money related, 60% tax rate. This is winnings, 30% tax rate. This is short-term capital gain on sale of listed equity share, units of equity oriented mutual funds, units of Business Trust of India, ULIPs. Okay, listed ULIP, something, getting it. Anyhow, ULIP related discussion at CA Inter we don't have. That is the reason why in here it is 10%. Getting it. In 112A and 111A, there are 4 assets actually. Listed equity shares, units of equity oriented mutual funds, units of business trust, and ULIPs. So that is also covered under 112E to 112A because ULIP is a capital asset now. So that capital asset. So 112A covers ULIPs also. But we did not discuss ULIP related point when we are covering 112A, 111A because we don't have in the syllabus, even in the ICS study material also, they have not covered at all. Fine, anyhow. And capital gains generally taxable. In all these sections, 112A, 111A, 115BB, 115BBE, in all these sections, commonly they have given one word. They have given a sentence. These incomes are not eligible for 6A deductions. These incomes are not eligible for what? 6A deductions you can't claim. So which means from gross total income, if at all while you are computing gross total income, if at all these incomes were there, eliminate them. Now balancing figure is there. Those are called as normal incomes. Normal incomes which are taxable at normal rates of tax. Normal rates of tax means what? These are the incomes that are taxable to SSEs at normal rates. For a company, normal rate is 30%. Foreign company normal rate is 40%. Individual slab system. Partnership firm LLP 30%. So that's normal rate. So for normal incomes, whatever is there, only from this chapter 6A deductions we can claim. Remember, getting it? And you know what? The chapter 6A deductions cannot exceed income. Suppose if my total normal incomes, which incomes other than special incomes, these special incomes straight away not eligible. So if I have, for example, I have 2 incomes, PGBP income, let us assume some 10 lakh is there, example, and I have a long-term capital gain of 10 lakh. So my gross total income technically speaking 20 lakh. But for the purpose of chapter 6A, 10 lakhs which is long-term capital gain, this is not eligible for chapter 6A. Only 10 lakhs only I can use for chapter 6A. Suppose I have 6A deductions. Total deductions came 12 lakhs. Total 6A deductions value came 12. Here my gross total income is 20 lakhs. But how much I can claim? Maximum I can claim 10 lakhs only because only that is the income which is available for taking deductions. So chapter 6A deductions cannot exceed gross total income. By the way, gross total income means which income? Only that portion of gross total income from where we can claim 6A deductions. That portion of gross total income which includes long-term capital gain 112, 112A, short-term capital gain 111A, winnings, casual income like which is taxable at flat 30%, black money income which is taxable at 60%. No, these incomes are not at all eligible for deductions because in the respective section itself they boycotted, they debarred 6A deductions. So remaining all other incomes are eligible for so that we can claim deductions from that income, provided the total amount of deductions shall not exceed gross total income. Gross total income is only that portion of gross total income other than special incomes. Please remember. Understood? Again, remember, dividend is normal rates of tax. It is eligible. Short-term capital gain other than 111A, normal rates of tax. That is also eligible for Chapter 6A deductions. Now, they may give you a true or false statement in MCQ format. So, all short-term capital gains, Chapter 6A deductions cannot be claimed from short-term capital gain. False. Chapter 6A deductions cannot be reduced from 111A short-term capital gain. Not all short-term capital gains. Are you clear? So this is how we need to. So this is one important condition. So here you see my normal income is only 10 lakhs. Like my normal income means what? Salaries income, PGBP income, other sources income. Getting the point? Other than lotteries and all. So these incomes only eligible for Chapter 6A, and short-term capital gain which is taxable at normal rates. Only these incomes are eligible for Chapter 6A deductions. Are you clear? Now, so first of all, what is this Chapter 6A deductions? Now you see, we have not discussed the salaries, but we will discuss very soon. In salaries, whatever amount that employer is giving me, salary, monetarily or non-monetary, whatever non-monetary benefit. Suppose if a company is giving me car facility, I am working in a company as an employee, they are giving me car facility. That is also taxed at certain value. And a company is giving me for using the car, still it is taxable. Getting it? At certain, there is a valuation rule for that. At that rate, it is taxable. Company is giving me quarters. Getting it? Staff quarters, rent-free accommodation they provided me. That is also taxable at a certain value. Anyhow, once we come to salaries chapter, there we will be discussing. Getting it? I discuss salaries and total income at a stretch because they both are one and same. Rest all other chapters are, one category. Salaries and total income put together is a different set of category at CA into. Getting it? Don't worry. So now you see, but tell me, in order to survey, see, these are all my incomes. When I do business, you are giving me business expenditure as deduction, balance income you are taxing. And when I sell anything, you are taxing capital gains, you are taxing other sources, you are taxing house property, everything you are taxing. But I am doing so many savings. I am incurring tuition fee for my children. I am taking insurance policies. I am taking medical policies. There are so many expenses which are, very, very fundamental basic needs. What about them? Except food and cloth. For everything, you have a deduction under income tax. For your food expenses, no deduction. For that only basic exemption limit is given for an individual. If you are an individual, basic exemption is given because to satisfy your basic needs like food, cloth. Getting it? But for shelter, again, there is a deduction. Shelter means nothing but house. So if you buy a house, if you pay any loan on that, interest on that, you are eligible for deduction under house property. If you repay principal on that. See, when we take any loan from a bank for house, we pay EMIs. EMI means what? Principal plus interest. Interest amount we are claiming deduction under house property. If it is a self-occupied property, maximum deduction is 2 lakhs. Yes or no? Now, if I principal also I am repaying, what about that? That's an investment made by me for the economic growth. Because I am buying houses, economy is growing. Don't worry. If you are making any investments, or if you are doing something called savings and all, for investments and savings, he will give you deductions from the gross total income. Under each head, we don't give any deductions. Getting it? Under each head, respective head of income related deduction we will give. Generally, if you incur anything for your personal reason, suppose I took an insurance policy on my life and my family's life, you will get deduction, not under heads of income, but under Chapter 6A, where the amount you will calculate, this amount you will reduce it from gross total income. So we have many sections in Chapter 6A which will give you deduction for various investments that you are making. Getting it? So the list of deductions are 80C, 80CCC. In 80C, I think I can say more than 20 plus investment options were given. I think more than 20 plus were given. Let us have a look at it. The number. Almost 23 items were there, approximately 23 items were there. So 23 deductions they have given, 23 different varieties of deductions. So you are buying some deferred annuity plan, you are buying some pension fund, you are buying some, you are paying some contribution to provident fund, you are paying some insurance policy premium, you are paying tuition fee for children. Getting the point? Or you have taken housing loan where you are repaying some principal component, you are buying some savings certificate. Like that they have given so many items. Don't worry, we will be discussing. I'm only giving you an introduction. 80C, 23 deductions it has. 80CCC, pension fund of LIC. What is it? Pension fund of Life Insurance Corporation. Pension fund. Getting it? 80CCE. There is a, 80CCD. 80CCD. National Pension Scheme. What is it? National Pension Scheme. So in all these cases, no, you are paying something, okay, for some purpose, investment purpose, retirement purpose, something. So these three sections mainly deal with retirement benefit, pension benefit, risk benefit, like that. Getting it? Then we have a section 80CCE which talks about limits for deduction, which talks about limits for these three sections. Getting it? Then we have a section called 80D. This is about medical insurance. So medical insurance. Then we have 80DD. Then we have 80DDB. 80DDB. Then we have 80E. 80EE. Then we have 80EEA. Then we have 80EEB. In all these cases, you are paying interest to bank. Getting it? One section, no. In one section, no, 80E, no, you have taken education loan, higher education loan, for that you are paying interest. In this, no, you have taken housing loan, for that you are paying interest. In this also, you have taken housing loan, for that you are paying interest. In this, you have taken electric vehicle. Getting it? For which you are paying interest on bank loan. So these four sections deals with interest on loans. Then we have 80G donations, 80GG rent, 80GGA donations for scientific research, everything. 80GGB donation to political party. 80GGC, it also talks about donation to political party by normal people. This is by company. This is by others. Getting it? Then we have, 80JJAA. Then we have 80QQB. Then we have 80RRB. These two are income-based sections. These two. This one is also, let me list out. Then we have 80TTA. Then we have 80TTB. Then we have 80U. Getting it? These many sections we have right now at CA Inter. Still in CA Final, you have many more sections like 80IA, 80 IAB, 80 IAC, 80 IC, 80 ID. Like that, some another 10 more sections for there, which we don't have at CA Inter. 80P, there is a section we don't have in CA Inter. 80 LA, we don't have in CA Inter. Getting it? So many we have. Imagine. Now, in these 80 QQB, 80 RRB, 80 TTA, 80 TTB. These four sections are income-based deductions. These four sections are what? Income-based deductions. Remaining all other sections which I have not highlighted, these are all outflow, payment-based deductions. Like you are paying something. For some reason, you are incurring expenditure, you are investing, or you are paying something, you are buying something. For that, you will get deduction. Whereas, these four sections which we have in our syllabus were income-based deductions, and this is 80JJAA. Getting it? And in these, again, these three sections, they were covered under chapter 6A, heading C. What is it? Heading C. So in chapter 6A, deductions are broadly classified into A, B, C, D, like that headings. Getting it? Under heading C, these three sections were there. Under heading C, there are many sections. Some 12 to 14 sections were there. We only have in our syllabus 3, which are falling under heading C. Getting the point? And this section 80 TTA TTB, this is income based section, not heading C. Income based section. Getting it? And 80 QQB, RRB, 80 TTA TTB, which I have highlighted in green. These are income based deduction. You are getting some income. That income is deductible. Whatever income is there, that is deductible. Of course, subject to certain limits. Are you getting the point? All of you. Now what are all these sections? Each and every section, let us now discuss in detail. Getting it? Now which I have highlighted in red, like these sections, 80 JJA, 80 QQB, 80 RRB. In order to get these three sections related deduction, you must file IT return on or before due date. Remaining sections, I did not highlight, you see. Only these sections. So once again, I'll highlight with a yellow color. In order to claim deduction under these three sections, in order to claim deductions under these three sections, nothing but those deductions which are covered under heading C. If you want to claim chapter 6A deductions which are falling under heading C, SSC must file IT return within the due date. 139 subsection 1 due date. Only then you will get all these deductions. Otherwise, you will not get any deduction at all for these three. For remaining all other sections, even if you file return belatedly, lately you are filing after due date, still you will get deduction. And remember, in set off and carry forward chapter, we have seen one provision where in order to carry forward of all the losses, carry forward except house property and unabsorbed depreciation, you must file IT return within the due date. Correct? We have seen this point or not? Yes. Now, without any late, let's start section 80C. Let's start section 80C. You see, 80C when I'm discussing, there's so much of content in this. Whatever is important, whatever is relevant in this present world, only that I will focus more in depth. Remaining, I'll just plainly read you and explain you simply. Getting it? Now, before going to ADC, first let me give a little introduction to it. Getting it? So, while computing total income of the SSC, by the way, did I list it out 80U here? Yeah, fine. Don't just I'm checking. Okay. In computing total income of an SSC, there shall be allowed from his gross total income the deductions given under 80C to 80U. So whatever deductions that are there from 80C to 80U, you can claim deduction. First of all, from gross total income, they said, right? What do you mean by gross total income? It is defined under 80B clause 5. Gross total income means total income computed as per provisions of the Act without making any deductions under Chapter 6A. So before deducting under Chapter 6A, what is your total income? So it is computed that deductions under respective sections have already been given effect, means under heads of income you have claimed all the deductions. Income of other persons if includable, that is clubbing, is clubbed. Intra-head and inter-head losses have been adjusted. Unabsorbed business losses, depreciation, everything has been set off. Still if you are left with some income, that's called gross total income. That too, gross total income, remember, please make a note of this point. Do not include incomes taxable at special rates. Incomes taxable at special rates. Example, I am giving you full set itself. 112A, 112, 111A, 115BB, 115 BBE. Getting it? These incomes are not eligible for Chapter 6A deductions. So, which means normal incomes. Salary income is eligible, house property eligible, business or profession eligible, short-term capital gain taxable at normal rates eligible, other sources incomes eligible. Getting it? So, remaining all other incomes, we can't claim Chapter 6A deduction at all. So, and further remember, the total of deductions, here itself the point is available here. The aggregate amount of deductions under this chapter shall not exceed gross total income of the SSC. What do you mean by gross total income? I have already told you. Suppose, if I have normal incomes, example 15 lakhs, special rates of incomes 10, gross total income is 25, but my total deductions are 20 lakhs, but I can claim only 15 lakhs in this example. I hope you understood. I already told you with a different number at the beginning itself. Next. Therefore, an SSC cannot have loss as a result of deduction under Chapter 6A. So, after claiming deductions, income cannot be negative. Income can be zero. So, there won't be a situation of loss because of Chapter 6A. Getting it? So that you can carry forward the same for subsequent. No, there is no. Carry forward is there only in the head of income. Getting the point? Once you set off with other heads, if still there is a loss, you can carry forward. After reducing Chapter 6A, loss picture cannot come. After claiming Chapter 6A, the total income of the SSC can be zero or positive. It cannot be negative. Total income cannot be negative, on which we compute tax liability. Yes or no? Further, this you remove. I will explain you these points in the respective section itself. Further, you will have deduction in respect of certain incomes which are discussed under heading C, deductions in respect of certain incomes. And if you claim any deduction under these sections, income based deductions under Chapter 6A, you cannot in any assessment year, it will not be allowed as deduction under other sections of the law. Why? Because no, you remember PGBP 35AD specified business, those businesses are once again covered under this income chapter heading C. Under chapter 6A heading C, the businesses which we discussed under 35AD were repeated, few businesses. Getting the point? Infrastructure development, housing projects. So like this, there are some things which are covered. The 35AD related things were covered. Getting it? So if at all you already claim a deduction under 35AD, you can't claim here. If you claim here deduction again, you can't claim under other provisions. For the same item, you can't claim double deduction. That's what the logic is here. Getting it? See, these points are mainly important at CA final. So these points, whatever I'm reading from here, no, that is not relevant at CA inter much. But just we will read once as a formality. Or else let me do one thing. Further, no, these items, no, you have to claim in the return of income, only then you will get deduction. All chapter 6A heading C. If you want to get deduction, you have to claim it. Then these items and all not required, ma. So I'll just strike off. Getting it? Market value, this and all not required. Where a deduction under these chapter C is allowed, is claimed and allowed, no deduction under 35AD is permissible in relation to the specified business for the same year or later year, whatever. If you claim deduction under chapter 6A for some business which is already covered on 35AD, you cannot once again claim there. If you claim there, you cannot claim here. In 35AD, we have seen this point. Once SSC claimed deduction under 35AD for the same amount, SSC cannot claim deduction under some other head, some other provisions. In short, once the SSC claimed benefit of 35AD, he cannot claim benefit of chapter 6A heading C only. Remember, I'm only talking about heading C versus 35AD. If you claim 35AD, can I claim chapter 6A? You can claim. Only heading C related you can't claim. Heading C means what? Income based deduction, certain items further you can't claim. Further, deductions under chapter 6A shall be allowed only to the extent of income computed as per the provisions of the act. That is included in the gross total income. That's what, no, that the chapter 6A deductions can be claimed only to the extent of gross total income. It cannot exceed gross total income. And further, this is another section actually. Here print was not, the print has not come 80AC. Getting it? What this provision says is, the provision is that in case failure to file return on or before the stipulated time, the undertakings would lose the benefit of deduction under these sections. These sections means below. So for all the below sections, filing of return is compulsory in order to claim deduction. Now they have given a very big list. No need to read at all. In this, what we have in syllabus is 80JJAA. 80JJAA we have in syllabus. 80 QQB we have in syllabus. 80 RRB we have in syllabus. Remaining sections we don't have in syllabus. And that's what here they have given. So these are all will be dealt at CA final level. So whatever I have given here, so 80 JJAA, 80 QQB, 80 RRB, only these three are there at CA inter. That too, these three are what? Chapter C related. So typically speaking, under chapter 6A, heading number C, those sections we don't have in the syllabus. And remember, under those sections, if you want to claim deduction, now you must file IT return on or before due date. If at all you want to claim deduction related to heading C. Under that heading C, there are so many sections. Only these three sections we have in syllabus related to heading C. Whereas remaining sections, 80C, 80D, 80DD, all these we have in our syllabus because they are not coming under heading C. Able to understand. Next. So now let us look into the 80C. Payment based deduction. So right now what we have seen is only introduction. Now we are actually discussing the deductions. Payment based deductions. So in this section 80C, we are getting deduction in respect of investment in certain assets, certain items, certain shares, certain deposits, like that. You're investing. Whatever you do here, whatever payment you are making here, it's an investment for you. Investment means what? You are creating some wealth. So that's what. So wealth related deduction. Section 80C provides a deduction from gross total income for savings in specified modes of investments. And remember, entire 80C section is only for individual or HUF. companies, partnership firms, LLPs, societies, AOP, BOI, artificial judicial person, local authority, they don't have 80C benefit. 80C is only for individuals or HUF. 80D is individuals or HUF. 80DD is individual or HUF. 80DDB is individual or HUF. Getting it? Almost most of the chapter 6A other than heading C, most of them are coming only for individual or HUF. Most of them. Getting it? Anyhow, I will be discussing. And remember, under section 80C, they spoke about 23 items of investments, right? 23 or 26 items of investments, right? All these investments you are making, example, totally you paid 10 to 15 lakhs. You are a high paid salaried employee. 1 crore is your salary yearly. You pay 25 lakhs investments. Will you get entire 25 lakhs deductions? No. How much ever you invest, that's your choice. But under income tax, we give deduction only up to 1,50,000 rupees in a year. So for particular assessment year, for a particular previous year, if you make any investments in these, remember, investment must be made on or before 31st March. So 1st April to 31st March of the previous year, if you make investment only, you can claim deduction for the year. Getting it? So they don't explicitly tell this, but you need to understand. Getting it? So the following are the investments or contributions. First one. Okay, these I am reading. Wherever it is relevant, I will be telling you. Getting it? Contribution to ULIP plan 1971. Nowadays, who are contributing to that ULIP plan? Now ULIP plans were very popular. Getting it? So contribution in the name of individual, spouse, children for participation in unit linked plan 1971. In case of HUF, contribution can be made in the name of the member. This point not required at all. Don't read next time also. Okay. Contribution to unit linked. So whatever I'm going to highlight in green color, that only you read in exam. Contribution in unit linked insurance plan of LIC mutual fund. If Life Insurance Corporation is running a mutual fund, to that you contributed unit linked insurance. So contribution in the name of in the name of the individual means the SSC himself or spouse or any child for participation in the unit linked insurance plan of LIC mutual fund. So this is important. Getting it? So if at all you are taking any unit linked insurance plan, what is unit linked insurance plan? Very simple. I think I would have told you in capital gains, because capital asset definition includes ULIP, which is not exempt under 1020 because of the premium amount paid exceeding 2.5 lakh in any term of the policy. Yes or no? Yeah. So ULIP means, see, only insurance people are not ready to buy. So what insurance companies have brought up, you pay 1 lakh premium yearly. Out of that, 90,000 we invest in stock markets. 10,000 is for risk coverage. If at all something happened to the person, whoever have taken this policy, you will get benefits. Sum assured you will get, insurance amount you will get. At the same time, if nothing happened also, don't worry. Whatever the amount you are giving, we are investing. So we will give you back after 10 years with so much of interest, so much of bonus and all. Getting it? So those policies are called as unit linked insurance policy. ULIPs. Getting it? Popularly called as ULIPs. ULIP of LIC mutual fund. Remember. So in case of HUF, no, the HUF can make contribution in the name of any member. So if at all you are buying ULIP policy from LIC mutual funds in the name of the SSC, spouse or children, in case of HUF, any member, the amount paid is eligible for deduction. Remember, whatever you pay under 80C related thing, maximum deduction is only 1.5 lakh. Please keep a note of this. This 1.5 lakh is the maximum deduction. Further. Next, suppose I am buying some life insurance policy. This is also called as ULIP only. Suppose if they say LIC unit linked insurance plan of LIC mutual fund, no, this is very outdated, ma. This is also not there for now. Or else you do one thing, not this. This also you strike off. Most of the ULIPs that you pay come under this third point. Most of the ULIPs that you pay come under this third point. Unit linked insurance plan of LIC mutual fund. So that is very outdated. That also, but just if at all in exam this point is asked, na, how much ever amount they gave, you claim that much deduction. Unit linked insurance plan of mutual fund, you can claim deduction without any limit, provided, what is the section limit? 1.5 lakh. Fine. Now, if at all I am paying any premium in respect of life insurance policy, if I make any premium, no payment for life insurance, no, on whose life? On my life, or my spouse, or my child. Child can be minor or major, it doesn't matter. Suppose I'm a 60 years old guy. I am making my son who is of 35-40 years age. For him also I am only paying insurance premium, life insurance premium. I can claim deduction, which means whether your child are dependent on the SSC or not dependent on the SSC doesn't matter. Generally, further one more point. Wherever in the entire income tax law, wherever the word insurance comes, you should pay premium by other than cash. You should pay premium by what? Other than cash. Such restriction is not given here. Such restriction is not given in the life insurance policy premium. Suppose we have a section called 80D, medical insurance premium. There you will get deduction only if you pay medical premium by other than cash, like by account pay check, account pay draft, or electronic modes only you will get deduction. Whereas in life insurance premium, where you are claiming deduction under 80C for life insurance premium amount, you can pay by other, you can pay by cash, even other than cash, because they have not specifically mentioned. That's a loophole, I can say. But nowadays, see, why for life insurance it is not mentioned, I'll tell you. Because most of the life insurance is done through agents. And agents, especially in rural areas, they go and educate the people and somehow get the insurance policies done, where the rural area people pay in cash only. They won't pay by banking mode, because no accessibility of banking facilities, or they may not be that educated to use banking channels, electronic modes, all that. So that is the reason. So for life insurance, compulsory restriction of using non-cash, they have not mentioned. Medical premium, generally medical premium will be taken by those SSCs who are of upper middle class and higher, because generally for lower middle class and poor people, generally government will be covering through certain health insurance schemes of government itself. So the most of the people who are having some ration card, who are having some white or pink card, something, depending upon the state, so some welfare schemes were there, so they are covering. So medical insurance premium, generally affluent and above middle class or above educated people only they will be taking. So generally they will have bank. So that's why in 80D, we have a section called 80D. Don't worry if you don't know, I'll bring it to that. 80D is a section which talks about medical insurance premium. You will get deduction only if you pay by other than cash. Whereas here, no such restriction. So it can be in cash, it can be in other than cash. Further, you can take in the name of children. And you see here, parents not covered. If I want to take insurance, life insurance on my parents, it is not covered. Only myself, my spouse, and my children. Only if I take insurance for them, it is covered. Life insurance, remember. Whereas medical insurance, if I take medical insurance policy on my parents' name, again deduction is there. Whereas here, parents is not covered. Very important observation. Life insurance policy in the entire ATC, one of the most important thing is this one. In ATC, there are some 5 to 6 deductions. There are 23 for the namesake. But 5 to 6 items only, very important. Don't worry, I will summarize it at the end of this particular section. Getting it? So, any premium paid on insurance of individual, family, children, you will get deduction. Children can be minors or major, doesn't matter. They may be dependent on you or not dependent on you, doesn't matter. Are they your son? Is he your son or daughter? Paid life insurance premium on their name, you will get deduction. Now, remember, life insurance policy may be a pure life policy, or it may be an endowment policy. In endowment policy, generally maturity benefit will come, or you may get cashback benefit will be there. So you are paying premium for certain 20 years like that. After that, you will be getting return whatever you pay, maturity, or you'll be getting monthly some amount cashback also. So that is called endowment policy. Whereas life policy means I just pay premium every year. Suddenly if something happens, I will get lump sum money. That's it. My family will get lump sum money. That's it. That's a life policy. What is ULIP policy? In the type A premium, out of that some amount will be invested in stock market. For sure I will get some money. So that is something similar to endowment policy. Be able to understand. Now you see, like now we are taking life insurance policy, right? So life insurance policy, now we are paying every year premium, right? How much deduction we will get? How much deduction we will receive? So deduction will be the following. If at all, policy issue date, if at all, or else, here the diagram is policy issue date. If the policy is issued before 1st April 2012, now whatever premium you are paying up to 20% of sum assured, you will get deduction. Getting it? Suppose the sum assured for insurance policy is 20 lakh. yearly I am paying 5 lakhs premium, and this policy, the sum issued 20 lakh, the policy is taken by me before 1/4/2012. When? Before 1/4/2012 I have taken this policy, and I am paying every year 5 lakh policy. Sir, 2 years only I have to pay, 2 or 3 years only. 4th year, 5th year I'll get maturity. That's a different thing. 5 lakhs I'm paying. How much I'll get deduction? Maximum 20%. Means what? 4 lakh. So though I paid 5 lakhs, I'll get deduction restricted to 4 lakh. And remember, 80C section limit itself is 1.5 lakh. Are you getting the point? Suppose if the insurance policy, the sum assured is 2 lakhs. The maximum restriction is what? 20% means what? 40,000. So if the policy is issued, if the policy became active before 1/4/2012, the premium paid is allowed as deduction subject to maximum of 20% of sum assured. Suppose if the premium is issued on or after 1st April 2012, on or after 1st April 2012, then the deduction is 10% of sum assured. Then the deduction is 10% of sum assured. Once upon a time, insurance premium sum assured is 1 lakh, 2 lakh like that only. But nowadays, insurance premium sum assured is 1 crore, 2 crore like that. Getting it? Fine. So from 2012 onwards, the insurance premium paid, you will get deduction subject to maximum of how much every year? 10% of sum assured. So only how much ever you pay premium doesn't matter, but you will get deduction only if the premium paid does only if the you will get deduction only up to 10% of sum assured. You will get deduction. Further, they have added one more point. Suppose if the policy is taken, if the insurance policy is taken on or after 1st April 2013, on or after 1st April 2013, that too in the name of a person covered under 80U section. What is 80U? This person is suffering from disability. Like leprosy, locomotive disorder, autism, cerebral palsy, like that. They have given certain disabilities. We will see all the disabilities when we are discussing 80DD, 80U, like that. Getting it? So don't worry. So if a person is suffering from disability given under 80U or 80DD, getting the point? Because these two sections talks about a disability. Getting it? So if a person is suffering from a disability mentioned under 80U, if that person takes an insurance policy on his name on or after 1st April 2013, remember, if at all this fellow, if the person is having disability, if this fellow take an insurance policy before 1/4/2013, but on or after 2012, for him 10% of sum assured only. Suppose if the same fellow have taken insurance policy before 1st April 2012, 20% of sum assured he can claim. But if at all he has taken insurance policy on or after 1st April 2013, 15% of sum assured deduction will be, originally I'll tell you what happened. So once upon a time, up to 20% of sum assured you will get deduction. Later on, 20% is too high. Nowadays insurance policies tenure is also very high. So almost 15-20 years, 10 years above it is there. So let us give deduction up to 10%. So when Congress government was there, when Manmohan Singh was the prime minister, that time they made 10% is the maximum deduction. But then that time, many people with disabilities, for them insurance premium is generally higher. Sir, for us, normal people 10% is fine. But for us insurance premium, they will charge very high, sir, insurance companies, because we are disabled people. So what about us? How can you give same benefit like normal people? Normal, non-disabled person, how he is getting? For us also, we are giving the same deduction. Okay. So, 2013 they amended. What they did? From 1/4/2013, if any insurance policy is issued, on or after 1st April 2013 in respect of a disabled person covered under 80U, he can claim deduction up to 15% of sum assured. So after modifying to 10, from 2013 for disabled people, 15% of sum assured, deduction is given. Are you clear? Now what are they saying? You have taken insurance policy. Okay. Which policy? Life insurance. On whose name? SSC, individual, spouse or children. Okay, what I will get deduction? Whatever premium you are paying, no, that is eligible for deduction. How much I will get deduction? If the policy is issued before 31st March 20, if the policy is issued before 1st April 2012, 20% of sum assured. If the policy is issued on or after 1st April 2012, 10% of sum assured. If the policy is issued on or after 1st April 2013 on a disabled person, 15%. Suppose no, for a disabled person, no. If the policy is issued between 2012 and 2013, I'm a disabled person. I bought the policy after 2012, before 2013, 10% only. If I buy the policy after 2013, disabled, 15. Suppose I am not a disabled. I purchased an insurance policy in 2014. How much percent is 15? No, 10 only, because I am not a disabled. 15% benefit is only for whom? Disabled person. Understood or not? Next, now insurance policy we are taking, no, so we are paying premium and we are claiming deduction under chapter 6A, everything is fine. After certain number of years, no, we get maturity amount in insurance. Okay, when you are paying money, you are getting deduction under section 80C, 20% or 10% or 15% or something. After some 5 years or 10 years or 15 years, you are getting maturity, lump sum, huge amount of money. What about it? It is taxable under other sources. Maturity proceeds from life insurance policy is taxable under other sources. However, there is a section 10 clause 10D. There is a section 10 clause 10 capital D, which gives exemption for maturity of proceeds from life insurance policy, only life insurance. This does not include other than key man insurance policy, So all life insurance policies where you are receiving maturity amount other than key man, that is exempted if the following criteria is satisfied. If the following condition is satisfied. Just a minute. So 1010D, what this section says, you see here. This section says, suppose you have taken a policy before 1st April 2012. Annually you are paying premium, annually. If the annual premium that you are paying, annually whatever the premium that you are paying, if it is not exceeding, greater than, I did strike, means it should not be more than, not exceeding 20% of sum assured. Policy is for some 5 years or 6 years or 10 years. You are paying premium every year. It should not cross 20% of sum assured. Remember, whatever you pay, it may be more than 20 or less than 20, doesn't matter. You will get deduction up to 20%. But if the premium amount itself not exceeding 20% of sum assured, not exceeding 20, then on that policy, if you receive any maturity amount, no, is exempt. That is exempt. This is not a commercial policy because you are paying premium which is less than the prescribed limit. Since you are paying premium every year less than prescribed limit, annual premium not exceeding the prescribed limit, it's a non-commercial policy. Non-commercial policy where you are getting maturity amount, purely retirement benefit, I understand, exempted. Suppose if the policy is taken on or after 1st April 2012, if the policy is taken on or after 1st April, then annual premium shall not exceed, it shall not exceed 10% of sum assured. Getting it? Suppose I have taken insurance policy today, 2023, I have taken insurance policy. Every year I have to pay premium. Sum assured is 1 crore. I have to pay premium just 1 lakh rupee yearly, which is less than 10% of the sum assured. Every year I am paying 1 lakh only premium throughout the life. 10 years I am paying. After that I received a maturity amount lump sum. After 10 years I have received a maturity amount which is lump sum amount. Now what is the tax consequence of this? Fully exempt. Why? The premium paid by you does not exceed 10%. Suppose every year I am paying 15% premium, 15 lakhs every year premium. Whereas the policy sum assured is what? 1 crore. Every year I am paying 15 lakhs. How much is eligible for deduction under ADC? Of course, 1.5 limit is there. But 10% first restriction, no, 10 lakhs. Then I will restrict it to 1.5 lakh. Able to understand. Suppose another. Suppose I have taken insurance policy, sum assured is 10 lakh. And I am paying premium every year 1 lakh 20. How much I am eligible for deduction? 10% only 1 lakh. But since the premium that you are paying is exceeding 1 lakh, 10%, You get maturity. Will that be exempt? No, taxable fully. Suppose if every year, no, you are paying premium. None of the year, the premium paid by you crossed 10%. Now you received maturity. Fully exempt. So, if insurance premium paid does not exceed 10% of sum assured throughout the life of the policy, and the policy is issued on or after 1st April 2012, entire maturity amount is exempt. Suppose if the insurance policy is taken on ADU disabled person, if that person has taken policy, that too on or after 2013, if that person is paying annual premium which does not exceed, which is not exceeding 15% of sum assured, then maturity amount is fully exempt. Remember, every year you are paying premium, no? It may be more than 10%, more than 15%, more than 20%. That's a different thing. You can claim up to 20, up to 10, up to 15, subject to overall section 1.5 lakh limit. But in order to get exemption for maturity amount, every year you have paid premium in the last 5-10 years, it should not cross 20%. It should not cross 10%. It should not cross at all 15% in any single year. Even in any single year, it crosses 10% or 15% or 20%, as the case may be. Maturity amount that you are receiving is fully taxable under other sources. Able to understand. Suppose no, I have taken a policy in 2014, 1st April 2014. Sum assured is 10 lakh. And every year I'm paying premium of 1.2 lakh. For 7 years I paid. 7 years. In 2023-24, insurance company gave me maturity amount of 25 lakh. Now, is this 25 lakh taxable or not is the question. Very simple. Every year you are paying 1.2 lakh. Now, what is sum assured 10? When the policy issued on or after 1st April 2012, you are not a disabled person. You will get deduction up to 10% now. 1 lakh you can claim deduction under ATC. 1 lakh like that you claim for 7-8 years. Now you got 25 lakhs. Now is it taxable? This is the question. Now, what is the condition? If the policy is issued on or after 1st April 2012, yes, premium payable every year shall not exceed 10%. Here, every year 1.2 I am paying, which is exceeding 10. Condition failed. So, entire 25 lakhs is taxable under other sources. There is one exception to this. Now, it is taxable now. For one case, in one scenario, this is also exempt. Generally, when maturity amount is exempt, if annual premium paid in past do not exceed 10% or 15% or 20% depending upon the policy issue date. Okay, only that maturity is exempt. But there is one scenario, there is one situation where annual premium, suppose in this example itself you see, normally it is taxable under other sources. Normally it is taxable under what? Other sources. But this amount also exempt when this amount is exempt when the SSE died. The SSE suddenly died. Before maturity itself, the SSE died. 25 lakh rupee was received by family members of the SSE because of the death of the person in respect of whom insurance is taken. In such a case, in the hands of the family, the policy is exempt. The insurance maturity amount is exempt. If the SSE himself received, and if last 10 years, even 1 year insurance paid more than 10% or check out as per the rule, exceeded, taxable in my hands. But I died, suddenly the person died. Family members received the benefit. So exempt. Able to understand. All of you. And remember, in case of keyman insurance policy, that's a different thing. For a keyman insurance policy, the maturity amount is always taxable. That's it. So now let's look at the concept. Now remember, whenever we are receiving any money from life insurance policy, when we receive generally money maturity amount, so any sum received under a life insurance policy, including bonus on such policy, shall not be included in total income. Nothing but shall not be included in total income means what? Exempted. The moment section 10 comes into picture, it is talking about exemption. The following tabular summary of the exemption available under 1010D and deduction is given. So ATC, deduction for life insurance premium and exemption, both are covered here. Suppose if the policy is issued before 2003, whatever amount you are receiving, before 2003, whatever the insurance amount is there, if the policy is issued before 2003, 20 years before the policy is issued compared to 2023, 20 years before you purchased a policy, today you are getting maturity amount. Fully exempt, no condition, nothing. That was a very old provision. And that time, no, if the policy should before 2003, that time if you take policy, now also you're paying premium. How much you will get deduction? Maximum 20% of sum assured. Insurance policies before 2003, they were not at all more than 10 years or 15 years tenure. Most of the insurance policies very, very less tenure. Getting it? Only term insurances were there. Only they have tenure of 40-50 years. Suppose I have an insurance policy whose tenure is 40 years. Getting it? Fine. Anyhow, so suppose now this is not that big deal. This is not a big deal. Suppose if the policy is issued before 2003, no percentage, nothing, you are getting maturity today, fully exempt straight away. No need to check anything. Policy issue date is before 2003. That time act is any maturity amount is fully exempt. Suppose if the policy is issued between 1st April 2003 and 31st March 2012. That's what I told. On or before 1st April 2000. Sorry, before 1st April 2012. That's what I told now. So before 1st April 2012, you see, before 1st April, how much reduction? 20% of the sum assured. How much reduction? Premium paid to the extent of 20% of the actual sum assured. So that much only is eligible for ATC deduction. Now further, suppose if the policy is issued on or after 1/4/2012, but before 2013, premium paid to the extent of 10%. Suppose if the policy is issued on or after 2013, for a normal person, premium paid 10%. That's what I told. No, if policy is issued on or after 1/4/2012, is it before 2013 or after 2013? Doesn't matter. If you're a normal person, no disability, 10% of sum assured. Suppose where the insurance is on the life of a person with disability or severe disability covered under 80U, or a person is suffering from a disease given under 80 DDB. Disease also covered. Sorry, please make a note. If a person is suffering from disability, or if a person is suffering from a particular disease, both of them getting it. If they have taken insurance policy, that too after 2013, 15% of sum assured, to that extent, up to that amount, whatever the premium you paid, you will get deduction. If you pay premium beyond 15, only up to 15% of sum assured only we will give deduction to. Are you clear? Now, okay, this is about payment, understood. What about maturity? Maturity amount is not related to chapter 6A chapter. That's a exempted income chapter, but since it is covered here, we are discussing maturity amount. So maturity amount is not part of this chapter, logically speaking. It's related to section 10. It's related to exempted income chapter. Now, what about the maturity amount? Suppose I have taken a policy. Before 1/4/2003. Whatever maturity amount I am receiving, fully exempt. Whenever you see. Suppose if the policy is issued on or after 2003, but before 2012, 31st March, on or before. So before 1st April 2012, you have taken a policy. Now, any sum received, no, that is exempt only when, suppose, no, exemption is not available when, if the premium payable during the term of the policy in any year, no, if it exceeds 20%, if out of after 1/4/2003, but on or before 31st March, means before 1st April 2012, I have taken a policy. If annual premium in any 1 year crossed 20% of premium, that's it. Maturity amount fully taxable, no exemption. Suppose, no, I have taken a policy after 1st April 2012. I am a normal person. And generally, amount received under maturity is fully exempt. However, if during the term of policy, for any 1 year, premium exceed 10% of sum assured, means it's a commercial policy, not a non-commercial policy, maturity is fully taxable. Suppose if the person is 80U 80 DDB person, getting it? So for him also exemption will not come when, if the premium paid by him exceed 15% of the actual sum insured any of the year during the term of the policy. Getting the point? Now here, at this point you strike off, that is not required. That is not required. Okay. So this entire thing is here only, this itself. Suppose if a person has taken insurance policy on or after 1st April 2012, but not suffering from disability or disease covered under 80U or 80 DDB, what is the criteria for getting exemption of maturity? Any year you should not pay exceeding 10%. Suppose, no, any sum received on death of a person by legal heirs, that is not at all taxable. The condition of 10%, 15, 20 would not apply in such a case. This is what I told you. Further, sometimes, We will take insurance policy on our family member. Suppose my example, there is an SSE who has a son. Because insurance policy can be taken on the SSE, spouse or son. Now the son is suffering from disability. So we have taken an insurance policy in the name of this son. So the SSE have taken a policy in his name. Like what is that? No, so it's a combined policy. If something happened to the SSE, this son will get the maturity amount so that his life will be without any interruption. It will be proceeded. What if son died before the SSE? Before the SSE, the son has been, he died. Getting the point? Now the SSE received maturity. It's fully taxable. That is fully taxable. No question of all the 10%, 20%, all that. Suppose any sum received under 80 DD3 shall not be exempt under 1010D. Accordingly, if the dependent disabled in respect of whom an individual has paid or deposited any amount in scheme of LIC predeceases the individual, before this individual the deceased person died. Getting it? The amount so paid or deposited shall be deemed to be income of the SSE of the previous year in which the amount is received. Such amount is not exempt under 1010D. That's it. So under 1010D, insurance amount we can't claim when, generally if we have any disabled person on his name, if at all we have taken any policy, if that fellow died first, maturity amount we received is fully taxable. Able to understand. I claim a deduction. I paid the policy, I claim a deduction. Getting the point? I paid the insurance premium on his name and I claim a deduction. And that fellow died suddenly and I received maturity. That is fully taxable. Exemption is not available. Exemption is not available for key man insurance policy also. So what is a key man insurance policy? It is taken by one person on the life of the another person. So generally which person will take? Employer will take. Employer will take. On whose name? Employee name. Where the first mentioned person, so who is employee of the first mentioned. So on the life of another person means what? Employee. So it is taken by employer. So generally during the business. So this point not required. Very simple. Maturity amount received under key man insurance policy is always taxable. If it is received by the company itself, in the hands of company, PGBP income. If it is received by employee himself, salaries income. If it is received by legal heirs of the employee, other sources, remember, told you. So we have an illustration 2. So illustration 1 and 2, both we will check out. For grant of deduction under 80 JJAA, filing of audit report in prescribed form for corporate assets is must. Filing of return is not required. Wrong. In order to get chapter 6A, heading C, in order to get this deduction, IT return must be filed within the due date. Here they are saying only audit report filing is enough. Filing of IT return is not good. That's wrong. IT return is only important. So the statement is not correct. Filing belated return under 139.4. You are filing late return. Will debar, will prohibit an SSE from claiming deduction under 80 QQB. Very good. Because 80 QQB comes under chapter 6A, heading C. Getting it? And under heading C, if you want to claim any deduction for any section, no, filing of return before due date is compulsory, on or before due date. If at all you don't file return on or before due date, if you file return late, it will debar the deduction. Correct? No, the statement is correct. So correct. Next, illustration number 2. Compute the eligible deduction under section 80C for the assessment year 23-24 in respect of life insurance premium paid by Mr. Ganesh during previous year 20-23. The details are given here under. So date of issue of policy is what? Before 1st April 2012. Whenever you see any date, no, you should only classify them before 2012 or after 2012. Before 1st April 2012. Issue of policy 2017. Nothing but on or after 1st April 2012. 2020 on or after 1st April 2012. By the way, he is a disabled person. On or after 1st April 2013 you should check. Yes or no? On or after 1st April. So on or after 1st April 2013, disabled person, nah, that's why. Fine. So no other question. Now for this, no, maximum is how much? 20%. For this maximum deduction, how much? 10%. For this maximum deduction is how much? 15%. So 20% means what? 6 lakhs into 20. Up to 1,20,000 is there, but SSE paid only 48. So entire 48,000 is eligible because 48 only he paid. Maximum is 20%, means 1,20,000. Here 10% only. 10% means what? 15,000. But he paid 20, so 15 only deductible. Now here 15% means 60,000, whereas he paid 80, so 60 only. So total deduction is what? 48, 15, 60. Yes or no? 48,000 plus 15,000 plus 60,000. So total answer is 1,23,000. This itself can be asked as a 4 marks question. Very simple. Or as an MCQ, they may test you. They'll give you option A 1,23,000. Option B, they will give this total amount. Options, they'll give all 20%. Like that, they'll confuse you. So compute the answer correctly. The answer is 1,23,000. They will give you an MCQ for 2 marks question. As a case-based MCQ, they may give. So 1,23,000. Easy or not? That's it. So one of the important concept in ATC we have completed. Then premium paid in respect of deferred annuity. Very simple. Annuity means what? I will pay every year some money when I'm young, when I'm earning, when I'm doing work, everything, when I'm hard working in a company, working as an employee, or maybe doing a self-employed. But I'm paying all this so that I'll get a retirement benefit annuity. So after 20 years, every month they will pay me some money. That's called annuity. What is it called as annuity? So if I pay any premium, no, for the purpose of deferred annuity, getting it, whatever premium I am paying, it is eligible for deduction. Remember, all these deductions, no, you total it as per the deduction limit. Entire ATC itself limit is what? 1.5 lakh. Suppose insurance premium I'm paying 10% of sum assured, that much only I'll get. 20% of sum, that much only I'll get deduction. Like that, you calculate all 23 deductions under ATC, total it, restrict to 1.5. Suppose if it is already less than 1.5, then that much would. Don't worry, we have problems. So, any premium paid to effect and keep in force a contract of annuity on the life of the individual, spouse, or children, provided the contract does not contain an option to receive in cash payment in lieu of the payment of annuity. Annuity means only monthly payment you should receive. Suppose if at all you're receiving lump sum amount at a time, it is fully taxable. That deduction you will not get. So if you are making any payment for annuity where you will receive after a certain number of years monthly some amount as a mature retirement purpose, then only you will get deduction. Suppose you are paying premium every year and you are suddenly getting lump sum one point of time. That is not the payment. Whatever you are paying every month or every year, no, you will not get deduction. A contract for deferred annuity need not be with insurance. It can be with a banking company also. Getting it? Such contract can be entered into with any person. Getting it? That's it. But however, this is not that important. Up to now, whatever we have seen, no, most important is third point. Most important is third deduction. The fourth deduction is not that required. Not that required. Then, suppose no, if a government employee, the government only paying amount deducted by the government from the salary of their employee, getting the point, for securing deferred annuity, for his spouse or children, getting it, the excess over 1/5 of salary shall be ignored. So up to 1/5 of salary, getting the point, 1/5 of salary. So basic plus DA generally, getting it. So if a government, while paying salary to the employee, they deducted some amount and paid to insurance company, paid to, deferred annuity, for deferred annuity purpose of their employee. How much deduction they'll get? Up to 1/5 of salary, employee will get deduction, because my money only they deducted. My money, it cut from my salary and paid, which means I am only paying. So this employee will get deduction. Up to 1/5 of salary, he will get deduction. Not important from exam point of view. This is again important. So until now, 6 items we covered. Out of that, third and sixth item only important, remember. Getting it? Only these you revise later on also, believe me. Next, contribution to statutory provident fund, public provident fund, recognized provident fund. You see, unrecognized provident fund not covered. Unrecognized provident fund not covered. Only recognized fund, public provident fund, statutory provident fund. Only these three are covered. Statutory provident fund is for government employees. Recognized provident fund is for private sector employees. Public provident fund for general public like you and me. Whether we are working or not in a company. I am a self-employed business person. I am not working anywhere as an employee. If I want provident fund, if I want to contribute to provident fund, public provident fund is available. Suppose if my friend is working in a company, Wipro, Flipkart, like that, my friends were there. So they are working in companies. No, company itself contribute to recognized provident fund. They will also contribute to recognized provident fund. Getting it? So I am an employee working in a company. No, my boss is contributing in my name to provident fund, and my salary I have to get monthly 5 lakhs. No, out of that 50,000 they are cutting. 50,000 they are paying to provident fund, means I am only paying that 50,000 every month which I paid. No, we will get deduction under ATC. Employee, his contribution he is paying, to SPF and RPF, that contribution he will get. So contribution to any fund to which Provident Fund Act applies, recognized Provident Fund, they qualify for deduction. Contribution to any Provident Fund set up by central government in this behalf, like public Provident Fund and all, that will also qualify for deduction. And the contribution can be in the name of individual, spouse, children. Getting it? In case of HUF, any family member. And you know, for PPF, no, maximum in a year you can contribute 1.5 lakh. Of course, in ATC itself also maximum deduction is only for 1.5. Now remember, for RPF and SPF, no, this is for employment people who are in employment. Getting it? What they will get deduction? Only employee contribution. Employee contribution. On behalf of me, my employer also contributing. That is not paid by me. No, my employer is bearing it. How I will get deduction? I will get deduction only if I bear it. So employee contribution, which is cut from my salary and paid, that amount I can claim deduction under ATC. So they are deducting and paying, no need to worry. You are getting deduction under ATC. Getting it? There is an illustration on this. So let's look into it. An individual SSE resident has made the following deposits or payments. Contribution to PPF 1.5 lakh. Okay. PPF, okay, that's it. So this is actually another point. This is first point, this is second point. Okay, please make a note. Then second one, what are the insurance premium paid on the life of the spouse? So on my spouse name, I'm paying a life insurance premium. When the policy is taken 1st April 2000, so after 1st April 2012, 10% of sum assured. Suppose if my wife is disabled, after 2013 we have taken, then 15%. Here nothing is given, so 10%. So 2 lakhs into 10% means what? 20,000. So 1,50,000 plus 20, total how much? 1,70,000. But under ATC itself, maximum limit is what? 1,50,000. That's it, 1,70,000. So maximum limit is 1,50,000. That's it. So this line has to come at last. You clear. Next, contribution to approved superannuation fund. So any superannuation fund is there that qualifies for deduction. You know, superannuation funds are again two types: defined benefit plan, defined contribution plan. Defined benefit plan, defined contribution plan. In a defined benefit plan, you don't pay any amount. Your company will pay on behalf of you some amount every month, like that. You will get a fixed amount. Getting it? Some amount your company will pay, you don't pay. So something they'll pay, and you will get based on your age, based on the number of years you worked in that company, based on your experience, based on contributions made by you in that company. Company will give at the time of retirement some fund to you, some money. That's called superannuation. Whereas defined contribution plan means what? You know, you are working in a company and I am paying to a superannuation fund maintained by the company. Every month I am paying some amount, fixed money. So based on my contribution, I'll get lump sum money at the time of retirement, plus my services and all. Based on that also, some money company will add. That is a defined contribution plan. Both are superannuation. Superannuation means amount received on retirement. Getting the point? So if at all, as an employee, if I make contribution to superannuation fund maintained by my company where I am working, that contribution is eligible for deduction. So you can remember this 367 until now. Any sum paid in Sukanya Samriddhi account for welfare of girl child. Getting it? So you see, Sukanya Samriddhi scheme has been notified by the central government. Getting it? So it is like subscription to any security of the government or any deposit scheme. Getting it? For the purpose of girl child, to provide that any sum paid or deposited by an individual in the name of girl child, or girl child for whom he is a guardian, legal guardian, that is eligible. Very simple. In respect of my child who is a girl. Getting it? If I contribute to Sukanya Samriddhi Yojana, Sukanya Samriddhi scheme, whatever amount I am paying, I will get deduction. This is also an important deduction. Getting it? National saving certificates not required. Very old. Suppose if I contribute to annuity plan of LIC. You see, before we have seen one point, deferred annuity. Here they have not mentioned LIC, insurer, nothing. Some deferred annuity you purchase with a bank or somebody. Whereas here you are purchasing annuity plan from LIC. So that you will get deduction. If you are purchasing annuity plan of LIC, suppose you are purchasing pension fund. You are contributing to pension fund of LIC. Pension fund of LIC is not covered under ATC. It is covered under 80CCC. There is a section called 80CCC which talks about pension fund of LIC. Suppose if it is annuity plan of LIC, ATC. Pension fund of LIC, 80CCC. This can be tested as an MCQ. So you need to observe these points. No, not that required. This observation alone is enough. This observation alone is enough. Not required. Suppose if you are contributing to pension fund of mutual fund or unit trust of India, not LIC. Pension fund of LIC is always covered under 80CCC. Normal pension fund of mutual fund or unit trust is covered under 80C, but not required. This matter not required. This is also not required. Old. These are all old items, but not removed. Maybe this can be. So until now, what are important? 3, 6, 7. 3, 6, 7, 8. Directly 14th point. So in ATC we have 23 items, 3, 6, 7 and 14th point. These are only important at present world as well as exam point. Suppose you are subscribing to some deposit scheme. Some scheme is a deposit where you need to deposit money of a public sector company which is engaged in long-term finance for construction or purchase of houses in India for residential purpose. So they do long-term housing projects or long-term infrastructure project or any deposit scheme of authority constituted in India dealing with and satisfying the needs of housing, accommodation, planning, development of cities, towns and villages. Getting it? So you are depositing money. You are paying money for deposit scheme of infrastructural purposes notified by the government authorities. So the deposit scheme should be framed by a government. Example, HUDCO. Getting it? So in these schemes, if you pay money, that is eligible for deduction. This is another most important thing. So insurance premium point, third point, that is most important. This is also most important. Suppose you are paying tuition fee to any university, college, school or other education institution within India only. Suppose if my son is studying abroad, for that purpose I paid some tuition fee, not eligible for deduction. If my son is studying in India, school, college, university, whatever, I pay fees to the college for tuition purpose, not donation, not admission fee, not club fees and all, only tuition fees, school fees, curriculum related fees, that only eligible for deduction. That too for maximum 2 children. Getting it? If I have 4 children, if I pay school fee for 4 of them, I will not get deduction for 4 of them. Only 2 of them I'll get deduction. So payment of tuition fee by an individual at the time of admission or thereafter to any university, college, school or other education institution within India for full-time education of any 2 children. Getting it? Full-time education, not distance. Full-time education means regular course, not a distance course. And remember, the benefit is only for the tuition fee for full-time education, not for development fee, donation, or any other payment similar which is outside India. That and all you will not get deduction. And another important deduction. Remember, until now we have covered 3, 6, 7 and even 14, 15. These 5 are important until now. Even 16 is also important. ATC at the beginning itself you write a note. At the end we will write, or right now itself we will write. In this, what are the points important? 3, 6, 7, 14, 15, 16. Okay, we will come back and write further. 16th is what? 16th is repayment of housing loan, including stamp duty, registration fee, other expenses. If I buy any house loan and I have taken a bank loan, every year I am paying, every month I am paying installment. Installment consists of interest plus principal. Interest amount I will get deduction under house property, 24 deduction, 30% of NAV, interest on loan borrowed, pre-construction period interest, current year interest, all that interest. Principal, I will get deduction under ETC. Not only that, in the year in which I purchase this house, at the time of registration, I will pay stamp duty fee, I will pay registration fee, I will incur certain other, mortgage deed expenses and all that also I can claim deduction. Any payment made towards cost of purchase or construction of new residential house property, provided the income of such property is taxable under house property, whether you are renting it out or own premises. You are only staying, doesn't matter. SOPI, LOPI doesn't matter. But the income of that house is taxable under house property. Suppose I purchased a house property for my business, staff quarters purpose, for my business purpose, that I am showing it as a depreciable assets in my block of assets. On that I am paying registration fee, all that, I will not get deduction under ATC. The payments are, what payments are covered? Installment amount you paid, part payment of the amount due. Like suppose you repay the loan, you repaid part repayment, that and all is eligible for deduction. Getting it? Installments means which portion? Only principal portion. Sir, they said installment. No, they didn't mention principal or interest. Very, very simple. Yeah, of the what? Like you see here. Any installment or part payment of what they said? Amount due. I am due to bank only principal. On that I will pay interest. That's a different thing. What is the outstanding amount? Only that amount if I repay only eligible for deduction. So amount due means principal. Amount due means what? Principal. Getting it? Whether you are getting under self-financing scheme of the government or development authority, housing board authority, whatever. Same way, whether any amount, any installment or part payment to any company or society of which you are a shareholder or members. Getting it? Like some companies, no, they do construct large projects, infrastructure projects. So where you pay 20% down payment, every month you pay 1% extra. So in this entire amount, principal is there, interest is there. Principal you will get deduction. Further, if you borrow loan from government, bank, LIC, National Housing Bank, public company registered, which is for residential purpose, finance and all, getting it, or a company in which public are substantially interested, which is into the financing of construction purpose, or SSC employer, where employer is an authority constituted by the government, or SSC employer, where the employer is a public company or public sector company, all that. Getting it? So very simple. Only legal payments which you pay, invite organized people, that only will get deduction. Suppose I borrowed a loan from my friend or my relative, I paid principal to him, will I get deduction? No. But you know what? In house property, interest amount you will get deduction, right? Whether you borrow loan from your friend or relative or bank, doesn't matter. Interest paid to them for housing loan, you will get deduction. Interest. For principal, you should only borrow from bank, financial institution, National Housing Bank, or your employer who is a public company, getting the point, or public government company. Only these people are allowed. And further, you will get deduction for stamp duty, registration fee, other expenses for the purpose of buying this house. So whatever additional expenses, stamp duty, repayment of amount, installment of amount, any amount or installment which you paid, nothing but principal repayment or part payment of the outstanding loan, this is eligible for deduction. Stamp duty is eligible for deduction. Registration fee eligible for deduction. What is not eligible? Remember, this is important for MCQ. This is important for MCQ. Getting it? So in this, MCQs can be tested. Even on the third point, MCQs can be tested. LIC point, life insurance point. Inadmissible. Suppose if I pay some admission fee, cost of share and initial deposit which a shareholder has to pay, like in a company, society, for house allocation and all, some additional expenses not related to house. The cost of any additional alteration or renovation or repair after issue of completion certificate. So building has been issued completion certificate, I purchased the flat, now I did some remodeling and all. No deduction. Any expenditure where deduction is allowed under 24, indirectly interest amount paid under 24 is not eligible for deduction. So interest amount paid is not eligible for deduction. So under 24 section, what you will claim deduction under house property? Interest payment. For that you will not get deduction here. Subscription to equity shares or debentures of an eligible issue. If they mention eligible issue, no, you will get deduction under ETC. Subscription to certain units or mutual funds approved by the board. Board means what? CBDT. Getting it? So that you will get deduction. This is important again. 19th point. So 16th. After 16, what is important? 19th point is important. After 16, what is important? 19 is important. Just a minute, we will see. 19, 20, 23. 19, 20, 23. 20 and 21 are that. Just a minute. 21, 19, 21, 23. 19, 21 and 23. So next time onwards, whenever you are reading this section, you should only read these items. That's enough. You need not cover any of the points. Directly read this. That's enough from exam point of view. Even in real life point of view also, these items are enough. Almost how many were there? 1, 2, 3, 4, 5, 6, 7, 8, 9 items were there. So 9 items. Totally 23 were given, but 9 were enough. Remaining all, you just give a formality. If I read that point, you should be able to observe that it comes under ATC. That kind of recognition is enough. Now, suppose in a bank, I deposited in a term deposit. Term deposit means what? Fixed deposit or recurring deposit. This is called as term deposit or time deposit. Time deposit or term deposit, both are for a fixed tenure, where you may pay monthly, recurring, or you may pay one time. But you are depositing with the bank for a fixed tenure. That's called term deposit or time deposit. So where you are depositing with a bank for not less than 5 years with a scheduled bank in accordance with the frame scheme notified by the government. Getting it? So that is treated as an eligible investment. You will get deduction under ATC. Of course, maximum limit of deposit, the maximum limit of investment, you cannot deposit more than 1.5 lakh. If you deposit 2 lakh, 3 lakh, that is not eligible for deduction. Of course, ATC limit is 1.5, but deposit limit is also 1.5 lakh. Not only that, even if you are investing in 5-year time deposit with the post office, that is also eligible for ATC deduction. And then deposit in a senior citizen savings scheme, okay, that you will get deduction. Now there is another point 23, contribution to national pension scheme. What is it? Contribution to national pension scheme notified. You know what is notified? You know, there is a notified scheme, Atal Pension Yojana. What is it? Atal Pension Yojana. So this is one of the notified pension scheme. Anyhow, regarding this we will be discussing in the next class. So in order to understand this, we have something called ATCCD. There is a section. Getting it? So national pension scheme, it has 2 tiers, tier 1, tier 2. Tier 1 is covered under ATCCD, tier 2 is covered under ATC. If you are contributing to additional pension, you see here, if you are contribution by a central government employee, remember this provision is only for whom? Central government employee. This 23rd item you will get deduction only for central government employee. This itself is important. They will test as an MCQ. There is a possibility. So if a central government employee is contributing to national pension scheme tier 2, that is nothing but additional account of NPS. In a national pension scheme, Atal Pension Yojana, we can have 2 accounts, a tier 1 account, tier 2 account. Tier 1, that is eligible for whatever contributing to tier 1 scheme, that is eligible for ATCCD deduction. Whatever I am contributing to tier 2, that I will get deduction, section 80C. Getting it? For a fixed period of not less than 3 years, which is in accordance with the scheme notified by the central government, it will qualify for deduction under ATC. It may be noted that only contribution to additional pension scheme, additional account of NPS tier 2, that will only come under ATC. Suppose you are contributing to tier 1, that comes under ATCCD, not ATC. Only tier 2 account is covered under ATC. That too, it is only for central government employee you will get deduction. If you are contributing to tier 2 of national pension scheme, you are eligible to claim deduction under ATC. This deduction is available only for which employee? Central government employee, not even state government employee. So these many contributions everybody will do. No. Suppose you see me, out of all this I have only one. Life insurance premium, I'll claim deduction under ATC in my real case. Maybe tomorrow if my son joins school, I'll claim school fee as a deduction under ATC. Remember, entire ATC as a whole, total deduction cannot exceed how much? 1.5 lakh. Now, in this, there is a provision called retaxability. What is it? Retaxability. Let me discuss that retaxability provision also. Or else I'll do one thing. Let me stop the class right now because retaxability takes some 10 minutes. Immediately, I have to cover 80CCC, 80CCD also. Getting it? So, in the next session, I will cover these items. So hardly this chapter will take as a whole 5 to 6 hours only, not more than that. Right now already 1.5 over. So another 3-4 sections will take another 1.5. Another 3-4 sections take 1.5. Last segment of 3-4 sections take 1.5 hour. That's it. With that, chapter 6 year deductions will be over. Are you clear? Okay. Take care.